Hi, everyone, and welcome to a special deep dive episode of the Property Trio. Today, we're a duo. I'm Kate Bakos, and I'm joined by Mike Mortlock. Dave can't be with us today, but Mike and I are here to unpack the freshly released 2022 to 2023 ATO Tax Stats. I can see your excitement already, Mike.
Yeah, I do love these ones. What I would love is that we're not going so far back in time. Like, as you said, like it sort of seems weird for you to say newly released and the 22-23 financial year when we've just finished the 24-25. But that's just the way that it
Yeah,
works because,
there's irony here. It is annoying because we love getting our statistics fresh and, unpacking them. And the two sets of stats that are really valuable that are always so delayed are the ABS ones and the ATO ones. So, yeah, dear old government, they're not fast off the block at all with stats, but it is always exciting to see the blend of findings from the ATO tax stats because each year we see some new trend, and
yeah.
today's no different.
Well, the amount of detail is why it matters. We get a really amazing insight into individual taxpayers and how many properties they own and what their deductions are and their net positive or negative positions. But just by virtue of the fact that, okay, we've just finished the 24-25 financial year, if you're registered with an accountant, you've got until May to do it, which is
Yeah.
nearly the end of the 25-26 financial year. And then, of course, the stats have to be compiled and put together. But it's worth considering we are looking back in time because the previous ATO tax stats, 21-22, we need to remember that was record low interest rates. So
Mm.
what was really interesting about that particular one is that these stats come out and the media always talks about the negative gearing benefits, the tax losses. Well, that particular year, there weren't tax losses. No one really talked
Yes.
about that, but they'll talk about it this year because we're back into loss-making territory, which just kind of makes sense. Like most property investments would be loss-making based on these interest rate settings, and there's some predictions to say, well, that number should increase, and it will because interest rates increased as well. But
Of course.
look, I'm excited by it for sure.
Well, we're going to just celebrate that enthusiasm. And you've put these notes together. And what I loved about them is it's not just about investors. It's really for every Australian taxpayer. And this data tells us not just what we earn and pay in tax, but who actually gets to play the wealth game.
Yeah, and there's some interesting nuances to pull apart with it. Should we start with the individuals?
Yeah, let's do that. Let's begin with what the ATO calls key individual statistics. So the average taxable income across all Australians is now $74,240. That's up around 2.6% from the previous year. But the median income, so the mid data point, that's only $55,868, a full $18,372 lower. That tells us that half the country earns less than $56,000 a year, and yet they're still facing, very steep rising living costs, higher interest rates, and a growing tax burden.
It's not that
And
much,
that,
is it?
yeah, well, it's not when you think about the cost of living.
Mm.
So that gap tells us something really important. Averages are misleading because they're pulled up by the high earners, and most people earn less than the average. So when we build policy or investment strategies based on average income, we missed the lived experience of the majority. And it means that when you hear commentary around the economy doing well or people having more disposable income, it's not necessarily true for the median household. They're doing it tougher than what the headlines would suggest.
Mm. Another thing to pick up in what you said, I think is worth circling back to, is you said most people earn less than the average. It's not really
Yes.
intuitive, is it?
No, no, it's not.
but there are a series of outliers of people on ridiculous amounts that blows the average up. That's why we need the median. But yeah, let's talk about not just the gap, but also about gender, because of course
Ooh.
in the last couple of years the gender pay gap has been under review. I think in many respects we'll touch on a couple of points why the gender gap exists from a functional point of view, just because of the stereotypical different roles, but obviously there's a different discussion of people doing the same job and getting paid a different amount. That's obviously a big problem. But
Yes.
average male income's 86,199. The average female income is only $62,046. So it's just over a 24K difference. So even
Mhm.
though women's income has grown faster over the decade, quite a bit faster at 41.2% for the decade compared to 31.5% for men, the unfortunate news is that the absolute dollar gap has widened, not narrowed. And we see that reflected in the wealth accumulation. For example, women will typically borrow less, contribute less to super, and have less tax deductible leverage to work with. And speaking
Mm.
of contributing to super, when we're looking at super balances in retirement, those are quite telling as well. So the average male super balance is 192,000 compared to 154 for females. The median male super 68,000, and the median female super is 54,000. So
Yeah.
that's a $38,000 difference on average and a 14K gap at the median. So that's some really telling statistics there. It isn't just about wage inequality. It's about time out of the workforce, part-time work, unpaid care roles. And these are all the things that compound over time, I think, to lead us to these things if we isolate it from the people getting paid differently to do the same sort of job. And what it ostensibly means is that women not only retire with less, they also have less financial flexibility during their working lives. And that impacts things like risk tolerance, their investment strategy, and even confidence in financial decisions.
Yeah.
I mean, you're a woman.
Yep.
I'm not a doctor, but I
Yeah.
can
Well,
tell that.
no, let's talk about some of the
I
challenges. And
wonder how that. Yeah, I wonder how you feel reading that.
I feel sad and angry about it, and I'll share. And obviously, from a personal point of view, that's where the sadness and the anger comes. I remember taking mat leave, and there's something to be said about the confidence that you lose when you're out of the workforce for a little period of time. I mean, some people it's for an extended time. For me, it was short, but it's not just because you're out of the loop or you're losing learnt skills. In fact, dare I say it, I don't think that happens. It's a loss of confidence, and also a fear around being judged for your commitment to your family. I
Mm.
remember when Gab was very young, and I was in a very busy, very full time role. In fact, I was a director, and the Victorian state government, or whatever was going on at the time, we had strike action among the teaching fraternity for a period there because they weren't happy with their incomes, and that was impacting Gab's schooling. And she'd, what little kids are like. They come home with their school bag, and you've got to pluck out the squashed orange, and then maybe a note from the teacher. And I remember pulling out a soggy yellow note that had orange juice on it. And it was saying, we regret to inform you that tomorrow is a strike day. And you're just thinking, oh my God, how am I going to do this? I've got a board meeting. And the response at work wasn't great. I
Mm.
had a colleague that kind of gave me the eye roll and said, well, you're going to have to sort out something because, my wife, or we've got a nanny or something along those lines. And I just remember thinking, I'm just really paddling uphill at the moment. I'm trying to hold it all together, and this
Mm.
strike action's not helping at all. But I think women, I digress, but when you're coming back into the workplace and you know that, if your child's sick in childcare, or if they call you saying that they've, bitten some other kid, or they've got a snotty nose and they've got to go home, it's more likely going to land in your lap than
Yeah.
your partner's. And so that's difficult for a lot of women. and that loss of confidence around how serious you're going to be taken at work. I remember another time in a corporate role I had, when I announced I was having a child, um, and I said, "Look, I'm really keen to return to work. I'm going to take X amount of time off." You know, I had a plan, and I got an eye roll from one of the senior male colleagues saying, "You're probably just going to have another one anyway." So there's a lot that women have to deal with, and admittedly, this was 20 years ago, and I'm really pleased to see that there's been a marked change in the last decade. But I think loss of confidence and lack of a willingness to step back into a big role certainly holds the income piece back, because you know if someone's nervous about their ability to commit or they've lost confidence, it will be reflected in the role that they take and the ambition that they show.
Mm. Yeah, look, I think there are some. I mean, hopefully, some of those things you just talked about stay back 20 years ago. I mean, even 20 years ago, it's probably a little bit late in the piece to have, objectionable views like that. But
Mm,
hopefully, things are a little bit better, and there is a little bit more opportunity in terms of working from home, piecemeal stuff, gig economy. There are opportunities, but
yes.
they're not at the same level, are they? There's just no way to continue growing your income and your experience and your expertise when you're taking time off for work. And let's just
Mm,
say it's a husband and wife, exact same qualifications and degree in a similar role. The wife takes time off to raise a child or at least give birth. Then the husband could potentially make the next step, or they're in the right space to grow their knowledge, to grow their salary and that sort of stuff. And as you say, if there's a sick child, it's like, oh well, like I'm now at this level, so it's assumed that you're going to be the one to look after it because I'm earning more. And there's a lot of systemic problems with that, isn't there?
yeah, yeah, there is. I think some of the best models I've seen is where it really is shared care. Sometimes you see, obviously, we're talking about hetero couples, but whether it's same sex or whatever, but often you see both partners get an opportunity at a different time to take time off to, to be at home, whether it's full time or on a more part time basis. I think we're getting our heads around it, but when you look at what's going on overseas, particularly in some of the really advanced European nations, I think they just do it so well.
Mm.
And we do still have a long way to go here. We do.
Yeah, I think so. And yeah, look, not just the gender difference. I think in many respects, it's kind of some harrowing reading in these particular stats. And really, the kicker that I think journalists have missed this time around is that the median net tax paid rose 16.6% in a single year, from $12,088 to $14,095, which is actually quite a huge jump, especially when the median income rose just 5.3%. So our extra tax was not covered by extra income. So that's something that I know that
Mm,
you've talked about quite a bit, the issue of bracket creep. It's real. This data, I think, proves that it's a problem, and it's hurting
yes.
Middle Australia.
Yeah, bracket creep is an important one, and there was a lot of commentary around the last tax reform piece. But I do also want to circle back to the year that we're talking about and the year
Mm.
that preceded it. We had lockdowns in a lot of cities and businesses that were severely impacted by COVID, and also decisions that people made to move away from the cities, and that can have a dramatic impact on income levels. So I'm not shocked that the net tax movement was 16.6%, because I think it's fair to say in a lot of categories people earned a lot more the year after we said cheerio to COVID lockdowns. What would you say?
True. Yeah, I think so. So, I mean, the data specifically will start from the 1st of July 2022, go to the 30th of June 2023. So it was kind of the tail end of COVID. But yeah, the impacts of it probably continued on far after we felt like it was a little bit contained, especially the impacts in Victoria. I mean, we've talked about it
Mm.
quite a lot, is that there's still impacts. I mean, you've got the land tax, which is supposedly the 10-year COVID repayment levy for all those expensive rings of steel you were building.
Yeah, so 8.5 years to go on that one. I'll be intrigued to see when they pare it back, but
I want to
I
bet
digress.
that it will never go away. I don't know who's going to take
Oh, I'm
those
not entering
odds.
that bet because I'm fearful that you might be right.
I just like if we talk about property and taxes in Australia, the government of all levels is really drunk on property taxes. I mean, when we talk about stamp duty alone, I think we're around about $1 billion a week. I mean, it's enormous. So,
It is. It's huge.
and especially with the Victorian economy not doing terribly well, I just kind of feel like to take that away, someone's going to look at the numbers and go, yeah, look, now's not the time. And they could be having that same discussion 100 years from now. I hope I'm wrong.
I do too. I really do. Before we move on to the next segment, you talked about bracket creep, and I digressed. But circling back to it, the middle is getting squeezed, earning
Mm.
only a bit more, but paying a lot more. The challenge here is that it hurts savings. It directly impacts home ownership, investment potential, and even lifestyle. So, a lot of people would say it's death by 1,000 tax cuts. When we look at disposable income in real terms, even modest wage growth can be wiped out by higher tax, higher rents, higher mortgage repayments, and inflation on essentials. So it's absolutely something that needs to be managed. And I can understand why the conversations come up every few years in relation to tax reform and bracket creep.
Well, the marginal tax rates are now different to what they were back then, right? So it'll be interesting
Yep.
to see the impact of that over time. And if you're sticking with this show and I'm still on it, I can guarantee we'll be talking about it every time this data comes out because I'm very interested by it. And I think it is interesting for policymakers and investors to kind of understand because the tax system isn't a flat system. There are points where people suffer more. There are points where people gain more. And one particular really interesting stat is the people that benefit from the capital gains tax exemption. So, stay tuned for that one as well if you are starting to
Oh,
nod off.
yeah. Yeah, no, but that's certainly topical. We'll be talking about that for sure. Um, I want to move on to part two of our app, and we're circling around who owns property and how many. And I
Mm.
do get excited about this. So, chatting about investors now, according to the ATO, there are 2,261,080 individuals with rental property interests. That's slightly down from the 2.268 million the year prior, and a whisper above the 2.245 million we saw in the 20 to 21 tax year. But here is where it gets fascinating, the breakdown by the number of properties. So those that own just one property is now at 71.8% of the total pool of property investors. Those who own two properties are at 18.7%. Those with three properties are at 5.7%, four properties, 2.1%, five properties, 0.8%, and six or more, because we can't count 7, 8, 9, 10, six or more properties, it's 0.85%. So those numbers have reduced slightly, those high end five properties or six properties, they've just come down a pinch from this time last year. So, all in all, 72% of all property investors have just one investment property, and that's the vast majority. And yeah, 0.85% of investors own six or more. And I recall it was 0.89 last year.
Yeah, it is a very interesting one. I mean, the percentage of people that own one property is broadly the same. What I think is most meaningful is that the investor pool has shrunk at a time where we didn't really want it to shrink. So again, we're talking about the 22-23 financial year, and that's really kind of the start of when we see those double-digit rental growth figures, right? That we were, talking about in the show last year and the year before. I think that's where it begins. And I can't remember the exact timeline. Obviously, we had an immigration lockdown essentially from COVID, but then on the back end of that, immigration at I don't know if it's record levels, but if it's not, it's very, very close. So it
Yes.
wasn't really a time where we wanted the investor pool to shrink.
Yeah.
What I suppose it tells us, broadly speaking, is that investing is widespread, but it's actually quite shallow. And what I mean by that is most investors aren't sitting on empires or big portfolios. They're likely just holding down one property, which is likely financed and often without the scale to manage effective risks. And that's something that I've talked about for years and years and years, about the percentage of people that own one property. I would argue that one property is not necessarily enough to leverage yourself into a position where you have, pure financial freedom. But I think we also hear so much about people that have, 20 or 30 properties or 10 properties. But like what the data is showing here is that that's probably an unrealistic goal for a lot of people. But I think we have it in our head. Unless we have 4 properties, unless we have 6 or 10 properties, we're not really successful. But if you have 6
Mm.
properties, it's less than 1% of all investors. And not every Australian is an investor. So it's already quite a tight pool. And over the
Yeah, well,
last
to
three,
absolute numbers, I think gives us, a good picture. It's under 20,000 people,
yeah, yeah,
under
exactly.
20,000 Australians.
Mm. Yeah, and you think about all the different occupations that are so highly paid, like surgeons and anaesthetists, who typically make up the top of that. I mean, you don't have to count a number of occupations like that to realise that, well, there's probably way more people earning, $500,000 or more than 20,000 Australians. But yeah, those numbers are pretty low. And over the last 3 years, they haven't really changed. Investors aren't gobbling up more property. From the data, it's really just saying they're trying to hold on to what they've got.
Yeah, that's pretty much it. It's compelling. Mike, I think we can chat about net rental outcomes by portfolio size.
Mm. So I prefaced that a little bit before talking about the 21-22 financial year, where there wasn't really any net rental losses. So in the 22-23 financial year, we had 49.4, or just under 50% of investors recorded an overall net rent loss. And that's up from 41.9% in the 21-22 financial year. So quite a big jump, and almost all of it came from the one property cohort. Obviously, interest rates were a little bit different in the
Well, yeah, a
22-23
huge
financial year.
difference. That's
Yeah.
exactly what hit. It wasn't just Victorian land tax. It was predominantly the interest rate increases. And as we all know, they started in May 22 and we had
Mm.
consecutive increases, and it was tough. And of
Yeah.
course, we saw a huge jump. Even though we had record high rental growth at the time, it wasn't nearly keeping up with the cost of the interest bill in the mortgage repayments.
Yeah, absolutely. And that's why commentators, well, like myself, I suppose, will say that it's likely to increase in the next year and then probably decline as we go into the interest rate sort of cutting cycle that we're in at the moment. Where I think it gets really interesting is when we sort of segment it. So the net rental losses for one property owners jumped from 688,000 to 810,000, and the profit or neutrally geared cases fell from 932,000 to 812. So that's over 120,000 investors who swung from profit to loss in just one particular year. So pretty big numbers there. And if we look at the
Yeah.
810,000 individuals with a net rental loss in 22-23, they shared a combined loss of approximately 4.3 billion. Now, I've sort of talked about this a few times, and I've said, look, the long run average, when I look at it from, just sort of scanning it, is around about the $3.6 billion mark. So we're pretty close to that kind of parity amount. But it averages a loss of about 5,300 per person, although, of course, the actual figures vary very wildly depending on the property type and the region.
Absolutely. I think that's well said. It's easy to think that these loss claiming individuals are, high flyers and big developers. It's not the case at all. A lot of them are middle income Australians who've scraped together a deposit, or they've waited for their equity growth in their own or occupied home, and they've jumped in potentially during the boom years, and then they've been hit by rising interest rates, rising costs, fixed rents due to tenancy caps or market pressures, and they're feeling these losses. In fact, I think about the investors that I help, and I've been helping for many years. I've traditionally, in the past particularly, I've targeted when someone's wanted moderated growth and stronger yield. So if they've said to me, look, I really want to be a property investor, I want some capital growth, but I can only sustain, X dollars a month in order to make this work. I've had to look at property types that will deliver a higher than average rental return, or a higher than average gross rental yield. And one of those markets that's done really well and done just that has been Ballarat. It's a regional market. And there are lots of equivalents of Ballarat around the nation, but in Victoria, to get into something at the time, I was helping clients spend, 250 to 350 on a house. They could get 5% gross rental returns, and then their out-of-pocket costs would be moderated. They'd still be negatively geared, but it would be, to the tune of a much more manageable number. And they certainly enjoyed the low interest rate environment and the cash flow positive nature of their assets during that emergency COVID time. And they're the phone calls that I've been getting when rates have gone up. So it's not just about land tax. It's when the interest rates have gone up, the mortgage repayments have increased, the cost of running the property in terms of minimum rental requirements and some of those mandated compliance checks. It's all starting to add up. And they're the ones that have given me a call and said, hey, we're now cash flow negative. And I think the capital growth investors that always knew that they had negative cash flow to contend with, they've kind of got their heads around it and they understand that. But when you've got someone that's engineered their purchase strategy on the back of being close to neutral, and all of a sudden they're hit with, you've just cited 5,300 per person, that's a make or break equation for a lot of people. So we do have to really think about the individuals that these increased costs of investing are impacting.
Yeah, well, it's about $100 a week, isn't it? There or
Yeah.
thereabouts.
Yeah, it's real money.
Part of the reason why we saw a reduction in the participation rate for property investors. And what I actually like as an unintended consequence of this is that I was hearing during the interest rate rising cycle, people that were uneducated saying that, well, landlords just pass on the interest rate costs to the tenant. Well, this is proof that that doesn't happen.
No, that old chestnut. It doesn't happen like that. Just because your costs have increased, it's about supply and demand. And if the market's not willing to pay it, or if they could go elsewhere and get the same product cheaper, you can't just roll through a rental increase. It doesn't work like that.
No, and here is the data proving that to be the case. So hopefully we can put that to bed. Otherwise, it's an easy copy and paste for any Facebook forums that pops up in again. So we looked at the one bedroom, the one property owners with an average of 5,300 loss per person. Let's compare that to the 6+ property crowd that what was it, 0.85%? Of property investors.
Yep.
Their net loss ratio is actually flat. So these are, I would say, more sophisticated investors. They know how to leverage depreciation, structure their loans, and even use trusts or company vehicles to distribute losses for tax purposes. They're also more likely to be positively geared or neutral through portfolio balance. And I remember in the elections that we had with Mr. Shorten, who was looking at getting rid of negative gearing and the capital gains tax discount, or at least adjusting it. It wasn't the multi-property portfolio owners that were talking to me about this being a bad idea. They were the ones actually saying, I don't really care. Like, I've got a big portfolio and my LVR has crept down over time. So I'm probably going to be positive after that anyway. It was disproportionately affecting those one property investors. And that's why I kind of thought, as a policy, it was harming the people that I don't think the intention it was to grab that extra revenue from.
Yeah, well said. When you think about the percentage of total investors, you're not going to make a difference when you've only got 0.85% agreeing with the policy.
Mm,
So, in a way, what you're essentially saying is the property market isn't collapsing, but it is consolidating. The small
yep,
scale investors are hurting, the large scale ones are doing it a lot easier. And that has long term implications for those who hold assets in this country, doesn't it?
it does, absolutely. And it's a good lead into the next thing I wanted to talk about is the structural nuances of the tax system. So we know that I mean, we hear a lot about things like negative gearing, capital gains tax disproportionately advantage the wealthy. Things like negative gearing will absolutely, by function of the tax system itself, it does, because the more you earn, the more tax you actually pay. So it's not a
Yeah.
balanced system. It's not a flat system. So the people that are trying to minimize their tax are paying a higher percentage of tax. Now, there's an argument to say, well, should they contribute to society if they're over a certain amount? I mean, I do believe that if you're on $1 million a year, you probably should be paying a little bit more than your share, because that's an obscene amount to need to live on. But it's interesting when we come up with a system and then we analyze how that impacts people, because there are some unintended consequences and some quirks that fall under the radar. A la negative gearing, as I mentioned, benefits those with higher marginal tax rates. So a $10,000 rental loss is worth much more to someone on 180K than someone on 70K, just because they're paying that high rate of tax. Now, I
Yeah.
reference capital gains tax discounts, and this one is a bit of a shocker. Overwhelmingly, the CGT discounts benefit a tiny sliver of Australians. So 0.2% of individuals claimed 46% of all capital gains tax gains, which is a huge
Yeah.
number. I wanted to see what you thought about that one.
Well, 0.2% of individuals, let's break it down.
Mm,
Um, yeah, it certainly shines a spotlight on a select minority that are getting that full benefit. And we've talked about, well, we've seen the government talk about changing CGT discounts, and a lot of people are quite fearful about the impact of that. And this statistic was a surprise to me, actually, Mark. I didn't expect it to be 0.2%. I thought it would be a much bigger number.
yeah, yeah. I mean, that makes sense. Like, because we hear about that all the time. It's a bit like the Pareto principle or the 80-20 rule. We know for a fact that, there's a small percentage of people earning a big percentage of the potential salaries. But yeah, capital
Mm,
gains tax is just one of those things where the more wealthy you are, the more likely you are to expose yourself to a capital gains tax event, because you have to own an asset, whether that
yes.
be a property. And of course, you can own a $500,000 property in Ballarat, as you were talking about, or you could own $100 million commercial property development. You could
Mm,
own a laundromat, or you could be a majority shareholder in Atlassian. So the capital gains tax spectrum is absolutely enormous when you
it
think about
is.
what you
It
can own.
applies to the sale of anything that triggers a huge gain. So whether it's investment property, whether it's like share portfolios, sale of a business, there's a lot there, and I just wonder why it's restricted to just 0.2%, or are a lot of people selling and not having gains? I mean, there's some real questions to be asked here, and I was quite shocked by this one.
Mm. And I think one thing that we sort of probably anecdotally understand, that there is a systemic reward for already being wealthy. I don't think necessarily by design. In fact, by design, we've got that the tax rate that penalizes you as you earn more, is one way to put it. But in effect, the system does amplify the advantage. And on the other side, it also amplifies the risks. Like when we're looking at those one property landlords, without the proper tax advice and the ability to hire the right experts to make sure that they are taking advantage of all of their entitlements, many people are running blind. Rising
Mm.
interest, rising tax, people not getting advice like getting a tax depreciation schedule or structuring their loans in the right way. It can be dangerous for these people that are starting very modestly trying to grow wealth compared to these people that have a team of advisors around them that are specialists.
Yeah, very much so. And if you're a low or a middle income woman, statistically speaking, you're less likely to own property, earn less, contribute less to super, and benefit less from every major tax concession. The system is technically available to everyone, but practically, it does reward those with money, knowledge, and advisors, to your point, Mike.
Yeah, absolutely. And I mean, we've gone through some of the stats of the difference between men and women. And the reality is, if you're earning less, if you have a less of a super balance, then you're less likely to take advantage of all of your entitlements. I've shared on this show, some of the stats about the percentage of people that don't get the advice on, say, getting a tax depreciation schedule until it's too late. It worked out to be 6.7% of property investors, and on average,
Oh,
individually,
ouch.
they lost $20,537 worth of deductions, which could be $8,000 gone from their pocket if we take, an average
Mm.
marginal rate. So those are meaningful amounts of money for people that as we've seen from the median income, aren't earning a tremendous stack.
I love how you just roll those stats off your tongue. Tell me, what sort of saving overall for our government is on offer when people are, forgetful or tardy about their tax deductions that they could be claiming?
Well, you can backclaim 2 financial years worth of deductions.
Yeah, but let's say people don't,
Yeah,
and the government then obviously gets a saving. They don't have to rebate anyone's tax back.
yeah,
How much are we talking? What gets left on the
yeah.
table?
So when we originally did that research, we looked at 1,000 residential transactions that came through our doors. So we knew exactly when they bought it and whether they would have back claims or not. So that 6.7% of people bought it more than 2 years prior to getting in touch with us. And then we worked
Yep.
out, okay, well, what would be that sliver of time, whether it be very small or very big? In fact, one particular investor lost about 14 years worth of deductions. But the average, as I said, was 20,537. You extrapolate that 6.7 that we did over 100 to the entire investor population at that same amount of loss.
Yep.
The figure was $2.88 billion worth of missed unclaimed deductions. And to reference that, 3.6 $1 billion was that average figure of negatively geared losses that I reported before. So there was kind of like $2.88 billion that was owed to property investors that the government kept. So nobody
Yeah.
really talks about that. And if we talk about, some little things like the government's trying to now legislate the 20% reduction in HEX, I think that's worth about $8 to $10 billion. So
Isn't that
that's actually
amazing?
quite a lot more money than what we're talking about here.
Yeah, very much so. I always think of you saying that huge saving would maybe deliver a propeller on a submarine.
Well, I've had to update some of my references because that when I first started talking about that, we had that contract with the French to buy those diesel submarines. And see, the thing that I hate about government sometimes is the amount of money that's wasted. I mean,
Yeah.
like many of us grew up like with some aged relative making comments about, oh, look at those council workers standing around doing bugger all, and we get sort of tuned into this injustice and this waste, but I don't know the details, but you can't tell me that committing to the French diesel submarines didn't involve a loss for us to then change and go to the AUKUS nuclear, whatever the stuff that we're doing. Like, because people have heckled at me during presentations saying like, oh, people shouldn't be trying to minimize their tax. They should be paying their fair share. I'm like, I would actually rather you get all your entitlements and give it to charity rather than the government, because the government will do less meaningful things with it than a charity will, especially one that you identify
Yeah.
with.
Oh, look what Pandora's box I've opened up.
I just get off my
Well,
soapbox.
I love it. Well, that leads us to the last part of our episode today. I want to chat about some takeaways for agents, lenders, and investors. I think for agents, let's chat about agents. It's time to educate buyers on more than just location and yield. They should be aware of tax offsets, depreciation, gearing structures. Buyers are cautious, but they're not disengaged. And obviously, we've all got to stay in our lane when we're having the conversations. But even steering people to the right professionals is really important, because they want education, they want to know how to make their investments work harder, and they're willing to listen. If they can get some really good facts and be pointed in the right direction.
That's something that I've sort of tried, like from my side of the equation, which is more the taxi sort of stuff, is to talk to people like yourself. You're a bad example of this because you're much more educated than the average buyer's advocate, for example. But buyer's advocates, property managers, real estate agents, there's so much to investing in property, and people should broaden their knowledge base to be able to provide the best possible service and advice. And that advice might be, do you know about this? Well, I can't tell you, but here's an expert you need to speak to.
Yes.
I think to sort of try and tie a little bit of a bow on it, I think the data is also showing us this: if you want to outperform the average, you don't need 10 properties. In fact, like, to outperform the average, you only really need one good one with the right setup. You want to make sure you claim all of your entitlements, like your tax depreciation, understand that tax position, like you were saying with the capital growth investors who are aware that they might go into negative territory depending on the interest rate settings. But more importantly, and this is where we do probably miss Dave, is have a plan for how that asset builds wealth over time and how you can hold on to that, because we don't really want to be stuck into a position where we actually have to sell something because we haven't modeled that out properly. And speaking of Dave, I think it's also worth noting from a lender's perspective that the focus is shifting, and lenders are looking beyond serviceability to post-tax cash flow. So things like PAYG variations and depreciation entitlements, these can make a difference between a yes and a no from a financier.
Yeah, very true. Shout out to Dave. It's sad talking tax without our third musketeer here. Well, I think we're coming to the end. And just to recap, what does the data tell us? It tells us that the average Aussie is earning more but losing more to tax. Property investors are thinning out at the base. Women are behind in income, super, and tax benefits. The tax system quirks reward the top more than the middle. And the one property investors are hurting the most.
Yeah. And what should we take away from that? Well, I suppose it's kind of like a report card for Australians. And as investors, as I think people that are listening to this show will either be or aspirationally be, we need better advice. We need clear strategies. We need more equitable access to wealth building tools. I think that is definitely happening. There's a lot more available to people now than there was 10 or 20 years ago. But the system does reward the few and punishes the underinformed. We can all lose out in the tax in tax in the long run if we're not educated to the way the tax system works and what your entitlements are.
Yeah, well said. I think you've nailed it, Mike. So, on that note, to our listeners, thanks for joining us on this extended journey through tax stats. We hope it sharpened your lens and armed you for some smarter investing, lending, or advising. Until next time, stay informed and stay curious.
See you later, taxpayers.